Alright folks, let's dive into something that'll make your wallet do backflips. ROE, or return on equity. You ever see a company that just seems to print money? That's return on equity in action. You can find the ROE for all stocks in the financial statements on whatever platform you use to research stocks. It's not hard to find. Most stock screeners out there also have a filter for ROE that you can use to find stocks with desirable row numbers. I once invested in a tech firm because their row was higher than my coffee addiction. Spoiler, that investment paid for a lot more lattes. But here's the kicker. Row isn't just some fancy Wall Street jargon, it's your secret weapon for spotting companies that turn your hard-earned cash into a money-making machine. Now, picture this. You've got two companies. Both look good on paper, but one's turning every dollar of equity into $1.50 of profit, while the other's barely scraping by with a measly quarter. Which one would you bet on? Yeah, I thought so. That's the power of ROE, baby. It's like a financial X-ray, showing you which companies are the real deal, and which ones are all smoke and mirrors. Let's break it down. ROE is simple math. It's a stock's net income divided by its shareholder equity. But don't let that simplicity fool you. It's like judging a book by its cover, except this cover actually tells you if the story inside is worth your time. A high ROE, that's management doing the cha-cha with your money, making it work harder than a squirrel before winter. Think of it this way. If Company A has an ROE of 20% and Company B is sitting pretty at 5%, which one's the better dance partner for your portfolio? Company A is taking your equity and turning it into a profit bonanza, while Company B's barely swaying in the breeze. That 20% row, it's like finding $100 in your old jeans. Unexpected, and oh so sweet. But here's where it gets juicy. A high row isn't just about today's profits. It's a crystal ball showing you tomorrow's growth. Companies with stellar ROEs are like that overachiever in high school. They're not just acing tests, they're setting the curve. They've got the smarts to reinvest profits, expand operations, and keep that money train rolling. Are you still there? Are you paying attention? I hope so. You better not be thinking of your next video to watch, because I'm only halfway through. Okay, let's keep going now. So listen up, let's talk numbers. What's a good row? Well, it's like asking how much coffee is too much. It depends. But generally, an ROE of 15 to 20% is like hitting the sweet spot in your favorite recliner. It's comfortable, reliable, and you know you're in for a good time. Anything over 20%, that's champagne and caviar territory. But be warned, if it looks too good to be true, it might just be. Super high ROEs can sometimes mean a company's taking risks that'll make your stomach do somersaults. On the flip side, an ROE between 5 to 10% is like lukewarm coffee. It'll do the job. But it's not exactly exciting. And anything below 5%, that's a red flag waving so hard, it might just fly off the pole. It's like a restaurant with no customers. Sure, it might be having a bad day, but more likely, something's off with the menu. Let me throw some real-world examples at you. Apple, they've been rocking an ROE above 70% for some time. This itself can tell you why it's been a hot stock for a long time. That's not just good, that's pinch me. I must be dreaming good. It's why their stock has been hotter than a summer sidewalk. Then you've got solid performers like Johnson & Johnson, cruising with an ROE in the high teens. Not flashy, but steady as she goes. The kind of stock that lets you sleep at night. But for every Apple, there's a company limping along with an ROE that wouldn't impress a piggy bank. I'm talking single digits, folks. It's like watching paint dry, except the paint's actually losing color. These are the stocks that'll have you checking your portfolio more often than your social media, and not in a good way. Here's the bottom line, folks. ROE is your financial metal detector on the beach of the stock market. It helps you sift through the sand to find those hidden gems. But remember, it's not the only tool in your toolkit. Use it wisely, combine it with other metrics, and you will be on your way to building a portfolio that doesn't just grow, it roars. So next time you're eyeing a stock, don't just look at the price tag. Peek under the hood and check out that return on equity. It might just be the difference between a portfolio that purrs and one that roars. Now, go out there and make those returns sing. I know I will be.